Recessions, as painful as they may be, often have positive effects on the economy. It's common for businesses to fail, individuals to lose their jobs, incomes to drop, asset values to plummet, and the government to be forced to borrow money in order to prevent a complete collapse of the economy. However, keep in mind that slumps in the economy are to be expected and are a common occurrence. Because of this, the next recession will offer some great opportunities as well, but only if you take advantage of them. If you want to know about exactly what's expected to happen throughout these next months, and what you can do to make money from it, keep watching. As was mentioned at the beginning of the video, recessions are accompanied by a significant increase in the rate of unemployment, a drop in wages, a loss of confidence among consumers, and a decline in values across the board, including stocks, food, energy, and services, with the effects sometimes lasting for an extended period of time. When individuals have less disposable income, they have less of it to spend, and when businesses see less demand for their products, they begin to cut back on their expenses, with employees typically being the first to lose their jobs. Businesses will have to start laying off employees. How this knowledge could be turned into cash. Number 1. Stocks and index funds. Before we start, please don't forget that this video is for information and entertainment purposes only, and not to be considered in any way as financial advice. Okay, here's the first one. If all else remains the same, a decline in stock prices will result in a rise in dividend yields. If a share of stock is currently trading at $100 and yielding 2%, but the price drops all the way down to $50, then that same share of stock will yield 4%. This means that shareholders who bought in at a lesser price will receive twice as much income. You'll want to proceed with caution in this area because some firms that lose half of their value have underlying concerns with their businesses that could lead to a reduction in their dividend payments. If, on the other hand, a high-quality company's share price falls simply because of unfavorable overall market sentiment, like during a recession, this is a fantastic opportunity to acquire a significant income stream at a discount. Stocks that fall in value during a recession often rebound and even set new highs later on. But for some companies, the decline is the beginning of a downward spiral that could lead to insolvency. For this reason, it makes sense for many investors to load up on index funds rather than trying to pick individual stocks during a bear market. Because index funds track the performance of the market as a whole. After surviving a bear market, the market indexes have always managed to recover and proceed to set new highs, despite the fact that moving forward, there are no guarantees that this will continue to be the case. Investing in individual companies may provide you with higher profits, but investing in an index fund is often associated with lower risk. Number 2. Real estate. The housing market can be influenced in various ways by the economies and the Federal Reserve's response to recessions. The Federal Reserve is known to reduce interest rates in the midst of a recession. To put it another way, this encourages individuals to go out and spend money, which is good for the economy. The result is usually lower mortgage rates, which open up more opportunities for home buyers. To those who manage to keep their jobs and incomes steady through the downturn, purchasing a property may be a sensible option. As the FED works to stimulate the economy, mortgage rates may fall, which, combined with fewer buyers and less competition, might lead to a decline in housing prices. Nonetheless, there are several dangers to consider during a recession, especially the prospect of widespread job loss. Consequently, if your financial situation is not ideal, you may be better to wait it out. Number 3. Cash. As the saying goes, cash is king during a recession, which summarizes the value of having cash on hand for investors when the economy is in a downturn. In order to enhance their financial standings, investors might use cash for a variety of purposes, including riding out market downturns or going all in on discounted assets. Holding cash guarantees that your account worth won't drop as the market drops. But if you count on holding too much cash, you may miss out on great investment opportunities. losing one's job or being saddled with excessively high utility bills are two of the most significant dangers people face during a recession. So having a healthy cash reserve allows you to face the unknown with less worry and uncertainty. However, one big drawback of having cash is the ease which we might spend it. It can be tempting to dip into savings when things are tough, as many people have done in recent years due to the recession. One-time purchases like a night on the town or a new piece of technology can quickly mount up. The next economic downturn may present a once-in-a-lifetime chance. Everything becomes less expensive. For most people, as prices of some things drop, we buy more, and conversely, as they rise, we buy less. The funny thing is, people do this with everything, except stocks. This thinking is not going to make anyone rich. Wise investors buy more stocks as prices fall. This is how a declining market can really work to your benefit. Less competition. During hard times, companies reduce their spending. They conserve reserves of cash and take less risk. However, this presents opportunities for the less risk-averse companies to come out to the front and take the lead. Here's an example. A study of over 10,000 businesses showed that those businesses who continued to operate and put themselves out there during a recession actually increased their value and still were able to achieve positive growth well into the return of market prosperity. There is a bull market after every bear market. Typically, history has shown that the market falls about 30% in a recession. Yet, from the bottom, stocks bounce back to show an average return of about 10% above the point from which they dropped. Within about 2 years, the market historically shows an increase of nearly 60%. This clearly shows that if an investor keeps buying on the way down, then the profits are much greater simply getting out and waiting for the market to return. Throughout history, over the long term, the stock market has always recovered far in excess of where it was before any recession. There were many valuable lessons to be learned by investors, many of whom saw their portfolios wiped out as a result of selling during the panic. Investments would have recovered completely and even increased in value if they had just held on. During a recession, this is the very first thing you learn. The stock market always recovers strongly once a recession ends. If you want to learn more about how to protect your profits, keep watching. How can you protect your profit? Scale back on your expenses. This very much goes without saying, doesn't it? This implies that you keep an eye on the market, reduce frivolous expenditure, and run your business or personal finances as efficiently as possible, all while continuing to put as much money as you can back into the market. Hold on to some cash, but also you need a safety net, a strategy for what you would do if your income were to decline by somewhere between 20 and 50%. How would you make up the difference? What kind of precautions could you take in advance to guard against the possibility of something bad happening to you? You should never stop working toward the goal of having sufficient funds in the bank to cover 3 to 6 months worth of living expenditures. The more, the better. If you lose your job or suffer some other type of income cutback, having some cash on hand is absolutely crucial during a recession. And if you keep your money in a savings account, it will grow into more money as interest rates climb. Protect your career. The worst case scenario is the market going into a recession and you lose your job at the same time, which could force you to sell your investments at the bottom. You should also take this opportunity to evaluate the skills you already possess and think about any additional education or skills you might need to improve your value in the eyes of your employer. Make sure that in addition to developing your technical talents, you are also working on developing your soft skills, particularly your communication abilities. You want to make sure that you are on top of your communication with your employers and coworkers so that you become more useful to your organization. This is especially important if you are in a leadership position. In spite of your best efforts, there is always a possibility that you will lose your job because of the current economic climate. You need to have a backup plan in case you find yourself in the position of having to look for new work unexpectedly. So, keep your resume up to date. Invest long term. During a recession, look for companies with robust balance sheets and stable business models. Utilities, consumer conglomerates, and defense stocks are examples. Investing during a recession might be smart if you're financially stable and have the correct attitude. Never sacrifice short-term security for long-term prosperity. If you're financially strapped, it's okay to pass up possibilities. Instead, focus on bills and health. You can always invest more when your employment is more secure, your wages are steady, and your mind is at ease. How you invest is as essential as what you invest in during a recession. In recessions, equities are volatile, as anyone who traded during the 2008-2009 financial crisis will attest. Instead of market timing, invest gradually. Dollar cost averaging involves investing equal amounts at regular intervals instead of all at once. If prices fall, you can buy more. You'll buy more shares at lower prices and fewer shares as prices rise. Since 1854, the National Bureau of Economic Research, or NBER, reports the average length of a recession is 17 months. Since World War II, however, the typical economic slowdown in the United States has lasted only around 10 months. The Great Recession of 2007 to 2009 lasted for 18 months. Although some recessions can be significantly shorter, such as the COVID-19 recession of 2020, which lasted for only 2 months. Despite the temporary nature of a recession, we do need to keep our guard up. To weather these economic downturns, we must learn to manage our finances wisely. If you want to learn more about having a wealthy mindset, click the videos on the screen. This video is for information and entertainment purposes only. The information contained in this video is not to be considered in any way as financial advice. Always check with a professional before making any investing or financial decisions. Your investments and financial decisions are your sole responsibility. Thanks for watching.